Most traders spend years searching for the perfect strategy, believing that once they find the right combination of indicators, entries, and confirmations, profitability will finally become permanent. They jump from one system to another, from one YouTube video to the next, always convinced that the next strategy will be the one that changes everything. But what most traders never stop to ask is a much more important question. Why do so many strategies seem to work for a while and then suddenly stop working? The uncomfortable truth is that the market is not static. It evolves, adapts, and changes as participation, technology, and behavior change. Strategies that once worked perfectly can slowly lose their edge, not because the rules are wrong, but because the environment they were designed for no longer exists. Many retail traders fail because they treat strategies as fixed formulas instead of flexible frameworks. They expect the market to behave the same way forever, even though everything about it is constantly changing. One of the biggest reasons strategies stop working is overcrowding. When a strategy becomes popular, especially through social media, YouTube, or courses, thousands of traders begin using the same entries, the same stop placements, and the same targets. At first, this can actually make the strategy look even more effective because similar behavior creates predictable price reactions. But over time, this predictability becomes exploitable. Larger players adapt, liquidity shifts, and what once worked cleanly starts producing more fake-outs, stop hunts, and inconsistent results. Retail traders interpret this as bad luck, but in reality, they are experiencing the natural life cycle of a strategy. Another critical reason strategies fail is poor context. Many strategies are taught in isolation, without enough emphasis on market conditions. A strategy that works well in trending markets can fail badly in ranging environments and vice versa. Traders who apply the same rules in every condition are essentially ignoring half of the information the market provides. Professional traders rarely ask, "What strategy should I use?" Instead, they ask, "What is the market doing right now, and how should I adapt?" This shift in thinking is what separates long-term survivors from those who constantly struggle. Psychology also plays a massive role in why strategies stop working for most traders. Even a good strategy cannot survive poor execution. Fear, impatience, and overconfidence distort decision-making, causing traders to enter too early, exit too late, or skip valid setups entirely. Over time, these small deviations accumulate and destroy the edge. Traders then blame the strategy instead of their behavior and move on to something new, repeating the same cycle. This is why many traders have tried dozens of strategies but never mastered one. What actually works in today's market is not a specific indicator or pattern, but adaptability and execution. Traders who succeed focus on understanding market structure, liquidity, and timing rather than rigid rules. They treat strategies as tools, not crutches. They know when to apply them and when to step aside. This requires patience, screen time with intention, and a willingness to accept that not every day offers opportunity. Risk management becomes even more important in this environment. A strategy does not need a high win rate to be profitable, but it does need controlled losses. Traders who survive changing market conditions are those who protect their capital first and let profits be a result of good decisions over time. Another key element that works now is simplicity. Many traders believe that more complexity equals more accuracy, but the opposite is often true. Simple ideas executed well outperform complex systems executed poorly. Professionals strip their process down to the essentials: bias, levels, timing, and risk. Everything else is secondary. This simplicity makes it easier to adapt when conditions change because there are fewer variables to manage. Consistency comes not from finding something new, but from refining what already works and adjusting it to current conditions. Traders who accept this stop chasing the market and start working with it. They understand that the market will always evolve, and their job is not to predict it perfectly, but to respond intelligently. This mindset shift alone can save years of frustration. In the end, the strategies that continue to work are not the ones that promise certainty, but the ones that allow flexibility. The market rewards traders who can think critically, manage risk, and stay emotionally stable in the face of uncertainty. Those who rely on rigid systems and shortcuts eventually get left behind. The real edge is not in the strategy itself, but in the trader using it.